Unit 5. The Real Estate Market Economy. The economy of the real estate market means the application of economic systems to the real estate market. Through the economics of the market, we get to know the pattern and trends in prices, demand and supply. These fluctuations are explained and speculation on the trends in the future can be expected. Research is studying real estate trends and impact on business and structural changes in industry. Research is based on micro and macroeconomic analysis, in terms of supply and demand, spatial economics, urban economics, wide research and findings. In this chapter we will look at some of the basic concepts in this field. The main roles in the real estate market are implemented by owner-user. Investors are owners and users of the property. It is a purchase of a residential property as an investment in order to live in the real estate. Owner-shareholder, they are owners who buy real estate only as an investment, without the intention of living in it. User-lessee, the user-lessee is not the owner of the property, but only uses it. Development, agencies and individuals that prepare some land for construction and plan the construction. Financiers and others, banks, brokers, lawyers and others who enable the purchase and sale of real estate. The value of real estate, as with other market products, depends on the costs that are necessary for their acquisition, as well as on subjective assessments of participants in the process of exchange. We distinguish two types of values. The value in use, which is a personal valuation of the value and is formed from the perspective of the individual user, and B. The value of the exchange or the market value achieved by the real estate in the process of exchange in the form of a price. Market value, on an incomplete real estate market, can be significantly different from subjective assessments of individuals. An objective appraisal of the market value of a property is often entrusted to impartial experts, values and represents a base price in the process of buying and selling real estate and in determining the amount of the loan for the purchase of real estate. Depending on the purpose of the appraisal, several other types of real estate values are distinguished: credit or mortgage value, taxable value, insurance value, etc. The property appraisal procedure usually includes 1. Determination of the physical and legal properties of the real estate, size, age, potential mortgage burden, etc. 2. Determining the types of property rights that will be subject to appraisal, for example, complete or only partial property right on real estate. 3. Determining the purpose of the appraisal, purchase contract, execution, etc. 4. Determination of the date to which the assessment relates, due to constantly changing market conditions. 5. Collection and analysis of data. 6. Use of methods for the final evaluation of the value of the property. In the case of individual real estate valuation, there are three basic methodological approaches. A. Market approach or approach of comparable sales. It is relatively simple and very realistic. It is characterized by the fact that it is directly linked to market data. It is based on the principle of substitution, which means that a rational buyer for a real estate should be ready to pay, as the maximum price, the price which equals the cost of acquisition of a similar property with the same utility. The market value of the property being assessed can thus be ascertained from the selling prices of comparable real estate. B. Income approach. It is usually used in the valuation of real estate that bring a certain permanent income. The value of the real estate represents the amount that the buyer would be ready to pay for the acquisition of the right to receive all future net returns of the real estate. In order to assess the value, all the future cash flows from the property and capitalization rate need to be determined. C. The cost approach is based on the replacement value logic, since it is presupposed that a rational buyer would be ready to pay for a real estate as much as the minimum cost of building a comparable property, real estate with the same useful value. It is necessary to estimate the value of the land and to add the costs of substitution and deduct from this amount the depreciation so far of existing facilities. The choice of method depends on the type of property assessed, the purpose of evaluation and quality of input data, each of which has specific shortcomings, and therefore the best results are usually obtained by taking into account the results of all three methods, which of course, consequently, also causes higher evaluation costs. The basic risks of investing in real estate are as follows. A. Business risk. It can be defined as the risk of change, reduction, of income from real estate, due to changes in the economic activity of a certain economic area that can cause people to move, reduce their incomes, increase operational costs related to real estate, deteriorate businesses, etc. These changes affect the demand for real estate and consequently the realized rents of investors. Investors can reduce this risk by dispersing investments in various types of real estate, which are of different sensitivity to this kind of risk, or with appropriate forming of lease contracts, for example rentals for which the lessor covers costs only up to a certain amount, and the difference is covered by the lessee. B. Financial risk. This is due to the use of leverage in financing the investment in real estate, since liabilities arising from debt financing are of a fixed nature. Therefore, in the event that the property does not yield an adequate return for a long time, liabilities to the lenders can cause the project to collapse. The investor can protect himself against financial risk with an appropriate debt structure, for example participatory loans, by refinancing or rescheduling of loans in agreement with the lender, etc. C. Liquidity risk. It exists on the market with a relatively small number of sellers and buyers where there are few transactions with certain goods. Low market liquidity means that the client who is forced to enter into a transaction within a relatively short period of time needs to pay an appropriate, monetary, premium. Relatively poor market liquidity is also common to the real estate market, especially for specialized real estate, for example health facilities, which cannot be easily adapted for other purposes. Therefore, there is a risk that the seller of real estate will have to sell the property at a discounted price in the event of a rapid liquidation of assets. D. Inflation risk. The rise in prices can lead to a reduction in the real value of income that an investor receives from a real estate, if he is not insured with appropriate measures beforehand, for example valorized rent which is corrected for the rate of price growth of consumer goods. E. Management risk. It is related to the ability of real estate managers, their innovativeness, adaptability, regarding the maintaining of real estate value and their expected yield. F. Interest rate risk. Changes in interest rates affect profitability of investments in real estate, because on the one hand they influence the investor's costs of debt financing, while on the other hand facilitating the potential tenants of the premises, fall in interest rates, or make it more difficult, rise in interest rate, for them to access cash, thereby affecting the price, rent, that they are willing to pay. Because in financing of real estate generally a relatively high leverage is used, changes in interest rates can cause significant losses or profits to their investors. As insurance against interest rate risk various financial instruments are used, for example, interest rate swaps, interest rate caps, etc. G. The risk of changes in legislation. The area of real estate is relatively heavily regulated, therefore, changes in legislation may have a major impact on their profitability. H. Environmental risk. Also changes in the environment, awareness of the harmful consequences of use of certain materials can have a significant impact on the value of real estate. For example, use of asbestos for the insulation of real estate was sometimes completely normal, but today it is regarded as a harmful substance, or for example detection of a nearby radioactive material deposit, etc. In the previous year and this year, 2018, there was a real estate boom in Slovenia, with real estate prices and, consequently, rents jumping into the sky, especially in larger cities. Since the economic crisis, when Slovenia has recorded the greatest fall in GDP, the GDP growth of 5% was recorded in 2017, although forecasts are no longer as optimistic as they were. After the end of the crisis and austerity measures, the number of transactions increased, demand for real estate has risen drastically, also under the influence of websites such as Airbnb, and with the expansion of mass tourism. The banks have also adapted to the demand, which eases the conditions necessary for obtaining a loan for the purchase of real estate. Residential buildings. I. Apartments. In 2017, The square meter of a dwelling in Ljubljana cost about €2,000. In 2018, the price is already approaching €3,000 per square meter. The value of dwellings increased on average by around 9%. The highest surge in prices was recorded in Ljubljana, where we also recorded the highest prices, while outside large cities, where prices are comparable, housing costs are growing at a comparably lower rates, but prices are also rising there. The rise in prices is due to lack of adequate infrastructure, as there are almost no luxury real estate, and there is still a lack of housing for young families that would end their problems in obtaining appropriate dwellings. Rental prices in the capital range around €12 per square meter, with the smallest dwellings being the most expensive. In the case of rented apartments, demand also greatly exceeds the supply, and it still grows, which also raises the prices. Thus, the price for renting an apartment of 60 m2 in Ljubljana can reach up to €600 without considering any living costs. Of course, both the price of a property and the amount of rent varies according to the condition of the property, the proximity of the city center, kindergartens, schools, infrastructure, etc. Houses. The prices of houses and their rents are the same per square meter as for apartments. However, it is necessary to consider that houses are relatively larger and therefore the price or rent is appropriately higher in terms of square footage. As far as houses are concerned, demand is also much larger than supply, so much so that we could talk about ballooning prices. There is especially a shortage of single-family houses suitable for young families. Commercial real estate. In the field of commercial real estate after the crisis, the rise in demand and, consequently, the prices of such real estate, commercial, service, catering establishments, have been recorded after the crisis, even though in the last year we see a slight decrease in prices. However, positive developments are supposed to continue. Due to the diversification of real estate, the market is very fragmented, which means great differences in supply and demand for different kinds and types of real estate. The same real estate is not suitable for both catering and business premises. The average office space price was around euros 1,020 per square meter for the territory of entire Slovenia. In Ljubljana, somewhat more, about 1,420 euros per m2, on average for premises over 30 years old, with an average space of 131 m2. The prices of these real estate are falling. For commercial and catering establishments, an average cost of euros 980 per square meter was required. In principle, the rooms are larger than 130 m2. Rental of business premises is nevertheless more accepted, and in principle also more favorable. In principle, rental of business premises amounts to around €8.40 per square meter, in Ljubljana approximately €10. Since these are older data, it should be noted that prices have fallen slightly during this time. What is the profitability of investing in real estate? Depending on the situation on the real estate market and type of investment. The assessment is in any case a mere estimate, as it is not possible to predict all the factors that affect the prices of real estate. The profitability of real estate from received rentals is currently, in 2018, 4 to 5% per year, as we are in a situation of great economic growth, with the market booming again. Rental prices have also grown due to the lack of available rental apartments. In his timely tips for new real estate investor, Gulharabhi notes that there are many factors that an advisor must warn a foreign investor about before entering into an investment in real estate. 1. An investment in real estate is a business and should be taken into account as such. 2. A business should be started with a good plan based on extensive research. 1. An investor should be aware of his abilities and weaknesses. Prior to recommendation of any property to a foreign investor, it is first necessary to inquire about the location of the property and to estimate its indicative market value. In this regard, the positive, for example the proximity of the school, kindergarten, shops, city center, as well as negative factors, such as air pollution, noise, parking problems, etc., are taken into account. It is important to identify and evaluate any potential risks associated with an investment, as there are large amounts at stake and a large number of risks are usually associated with property ownership. In order to avoid them or reduce them, it is necessary: identify different possible risks related to the investment. Understand and evaluate all possible risks associated with the investment. Assess all risks and decide on preventive measures.